Good evening, everybody. My name is Daniel Young. I'm the owner and founder of Adaptive Perspective and the Adaptive Perspective social media platforms. And I am back to talk about our stock market investment strategy using closed-end funds. This is an unedited video, so who knows what you'll hear in the background as I film these in my house because life happens. And it's a Sunday, and we're all getting ready for the work week, so you're going to hear some background noise. And maybe, who knows, maybe my cat will make another appearance. I am not a financial advisor. I'm a financial strategist, and I don't speak like the herd. I walk in limited company, and sometimes I walk alone. So this week I got more done, but it was a huge deep dive on the book writing process. And actually, we were driving around on Saturday. I'll put it this way. We were driving around on Saturday, and I told my wife, or asked my wife, hey, can you send me an email? She went, sure. Uh, it needs to include these things because those are the things that are still on my plate. And I've noticed that I like to be busy and I like to have a lot of stuff going. It really keeps me motivated to get more stuff done. But there comes a time when I hyper focus on activities because I need to get them done. It's really hard to get the other stuff done. And it's also like I realize the limits of my brain. Um, there's only so much space, there's only so much RAM, there's only so much time. So I've been hyper focused on writing and revising and editing, um, trying to keep up with our budget, trying to keep up with a lot of things. And I've got other projects that are still outstanding, but it's a work in progress. Uh, a little bit every day, sometimes a lot every day, but a little every day in the hopes of finally crossing something off the list, which allows me to both, hyper focus more upon a important activity like writing a book or anything else that's on that list. Um, but it also creates just a little bit more space where something can come in and fill the gap. So, where are we for the week? And I make these videos not so much to update my life or update you on my goings on, but really to break down the market and show you what we're doing, show you what I'm targeting and why, really explain my thought process. So what happened this last week? Well, you ever feel like the Fed is tightening the noose around your wallet? Because I do. And they finally cut rates, but only a measly quarter point. My cat is going bonkers. They finally cut rates, right? But only a measly quarter point. The market's confused. Consumers are squeezed. That'd be me and you. But there's opportunity here if you know where to look. So yes, the Feds finally, or the Fed finally cut rates, but it's too little too late. It's a measly quarter percent, 25 basis points after a year or almost a year of nothing. That's a drop in the bucket. And I understand why they didn't cut it deeper. I mean, the market's reaction was telling. Stocks were up, bonds went down, which is the exact opposite of what should have happened. Normally, when rates fall, bond prices rise. Like that's finance 101. So why did bonds dip instead? Well, because we're dealing with the herd. The herd doesn't think, it just reacts. It does what it's told. The bell rang, somebody shouted sell bonds, and the herd stampeded. Easy peasy. Same old story. But what's the reality? Well, if we take a step back, we're looking at a snapshot and not the whole chart. Markets rise and fall. We know this. But if we can zoom out on the data, you'll see that bonds will recover. And in that bond package, you have President Trump and Secretary Bessent watching the bond market closely. And the bond market didn't like the move. I mean, it's saying the economy's strong. Why cut rates? That's their perspective inside a very well cushioned bubble. But outside that bubble, for you and me, the story is very different. You and I needed the rate cut. We needed a bigger rate cut. Prices are climbing. I mean, grocery with inflation supposedly going down, it makes no sense to keep rates high. But with inflation supposedly going down, cost should also be going down. But that's not been our story at the grocery store. Prices keep climbing, pay is stagnant, and consumers are feeling the noose tighten. And for nearly a year, the Fed has been on the noose. Their last cut was election driven, not data driven. This one, too little too late. And still, the bond market's tantrum tells us something important. The Fed has gone back to quietly printing money, and the bond market isn't ready for the party to end. So when the cut came, the bond market screamed like a toddler caught with his hand in the cookie jar. But for us, that toddler's tantrum is an opportunity because where the herd panics, we prepare. Where the herd panics, we use it. We buy the herd's fear and we profit off their greed, like we've always done. And discounted bonds right now, they look pretty good. But that's the here and now. Let's talk about where we're headed. The AI race is on. We've been over this. Money is flooding into it. But history says most of those players, most of those companies aren't going to last. Remember the dot-com era? Hundreds of flashy startups promising the future. Only a few, Amazon, Google, eBay, survived because they looked forward. The rest, gone. Like who knows who they are. So here's the caution. Startups will sound promising. IPOs sound promising. But you have to ask, will this company survive when AI is no longer the shiny new thing? If you only bet on hype, you will end up broke. So you got to look for companies with staying power, whose vision carries them beyond today's headline. And if AI is crazy, which it is, but if AI is just skyrocketing right now, it's got nothing on how it's reshaping the commodities market. I mean, data centers are popping up everywhere, and data centers need a lot of cooling. And natural gas is becoming their go to cheaper, more practical cooling method than a water utility. And that means opportunity, not just in producers, but in transporters, the toll bridge operators of energy. Think of it this way. So AI is going to be big, right? AI, we're on the forefront of that. And at some point it will end. And we don't exactly know what's next. But in the here and now of AI, on the forefront of AI, natural gas is going to be a big part. So let me put it this way. Your your cell phone company doesn't make the real money. The companies that manage the data do. So if you look at Crown Castle and AMT, they lease out those data towers to all the major carriers. So what Verizon does, or T-Mobile, or who else, Mint Mobile, they all take your money. But the real money isn't data. And it's the same way here. Producers drill and pump, but the midstream operators, the people between point A and point B that move the product, they get paid whether the price of oil or natural gas is up or down. So that's durable cash flow driven income. And in a presidency and administration who is bent upon pumping more, drilling more, that market is only going to accelerate, which is great because AI needs it. So midstream giants are well positioned to profit as energy demand from AI keeps building, but they're also set to profit as more oil is pumped. So where does it leave us? Well, here's what I would target specifically: bonds and their proxies. So you get bonds, municipal bonds or munis, utilities, real estate, BDCs, CLOs. Although I'm really hesitant on the CLO market for what I got into last week. The CLO market right now is really sketchy. Um, it's it's like a tweaky herd, honestly. It's the typical herd, but it's even more tweaked out on fear. And I think the fear is overblown. I mean, the fear is in default, but I think the fear is overblown. But that's me. That's not the herd that's skittery. In this specific herd, it's like an offshoot of the typical herd. It is jittery and tweaked is the best way I can put it. They are skittish at the moment. So CLOs fit into the bond proxy gap or under the bond proxy umbrella, but it's an extremely cautious add to the bond proxy umbrella. So we have bonds and their proxies, and then we've got US stocks with staying power. So not just the hype, right? But we also want stocks with exposure to real tech advancement. Like everyone should profit from AI. Everyone should profit from more tech. But we don't want just everyone. We really want to hyper focus and narrow down and cull out that group. And then the other is energy transfer, and it's energy transfer of oil and natural gas. If you can find cheap oil right now, so on the forefront of technology where everything needs oil, if you can find cheap oil, that's a great deal, right? And if you can find cheap natural gas, that's a great deal. But if you can still find like a merger of the three, cheap oil, cheap natural gas, and the toll road group that really moves that product all over the country, if you can find that, that puts you in great position. So let's look at where the discounts are for the week and let's see what we can find in the bargain bin. So let me share my screen. So this is the selection for the week. It's not the entire closed-end fund master, but if you're new here, all of these tabs, I mean, these individual tabs represent our recent buys. I moved our Webull portfolio to Fidelity. The Roth is one of my projects to resolve. And I'll put it on the video. I'm not a So I've emailed Webull and I've emailed Apex Clearing, who's their managing partner. I've emailed them both. How do I move my Roth? Because if I work with Fidelity to initiate the transfer, Webull still charges a $75 transfer fee, which Fidelity will credit back. The problem is it's a Roth. Any of your initial money you can take out at any time, but it's kind of a headache for your tax guy. If you've got dividend money, right, or money you've gained, that money can't come out. So how do I transfer the Roth to a different company or a different managing firm without incurring a penalty? How do I set that up? I've app messaged, emailed, social media messaged, and gotten just stone cold silence from Webull and from Apex. Nobody wants to respond back, which currently I would say both are holding my Roth hostage. And they are holding it against my will. And I don't really know how to resolve that. But my goal would be to move the Roth portfolio to Fidelity where it would join our cash brokerage. That's the goal. Um, but that's still a project I've got to work on. This is the closed-end fund master. It's not an alpha order. I can put it in alpha order. It's every closed-end fund. And It's been a while since I've done a full system update. I've this month I've got to do a full system update. It needs it. I need it. Um, but of the update, every fund that has a target, so either a single, double, or triple asterisk, gets updated weekly. So of that group, these are the triple asterisks, the funds, the companies, however you want to say, that have significant discounts in the sense of if it's a long-standing company, I'm tracking historical and 5-year data. And if it's a newer company, then I'm tracking short range data, anywhere from say like 3 to 6 years in some cases. So those companies have more leniency. So we're looking for, oh, let's see who's been around a while. So we're looking at the historical data and the 5-year data in relation to the company's existing discount. And any company who has a greater than double the historical discount and greater than the 5-year discount gets a triple asterisk. And the leniency would be for companies that haven't been around as long, like BRW. BRW is reformed. So currently it's 6.6, right? That fits in. That's better than the 1 year. It's a little bit below the 3 year. It's a little bit less overall than where it's been, but the price dip with the rate cut. So the triple asterisk list, I generally sort it like this. I normally look at monthly payers, unless there's a good reason to keep a quarterly payer. And there are a couple reasons. Me, I don't like me. I have a history of Aberdeen funds. I don't like their management strategies. Um, Other people love them. I don't. So Aberdeen, I don't know enough about Madison. Category 3 means it pays the third month of the quarter. So 3, 6, 9, 12. LE, DX, if you think we're in a low, so what's the advice? If we're in a low volatility period, DX is great because it sells covered calls based on volatility. So then when the market becomes volatile, it becomes a better deal. So you can pause it and read that. But USA, I still think USA is a great deal right now. It price wise has a low price, comparative has a great dividend. It's generally not this big of a discount. Uh, it just won't pay you a dividend until January. So it'll go ex dividend somewhere maybe in November, and you're not going to see that dividend until January. But maybe they would pay a special dividend based on interest rates. Maybe. So if we call out based on monthly, and then we look at overall yield, the goal has been 9% or better, unless, same thing, unless there's a good reason for keeping something else. So HFRO is the biggest discount. Now, that discount has also dropped considerably. I mean, it used to be 60% off. So for every dollar invested, you're essentially buying a share for 40 cents. And currently you're buying like it for every dollar invested, you're paying about 60 cents. 20 cents doesn't sound like a lot, but it is. So the price has also come up. So it's more expensive than it was. But that's honestly what you want. So UTG would not make it. HFRO being the biggest discount, yes. So if the price was, say, like 505, it would change the discount, right? But they haven't changed their dividend, right? So the overall yield has gone down because the price has gone up. But I'll keep it on the list because it's still got a crazy discount. But of what else is there? So I'm going to trim the list based on the parameters, based on these things. I am not an outright consumer guy. Now, when it when you look at US stocks and you look at companies who would benefit by tech, anybody mass producing goods, Kraft, Heinz, Del Monte, Crisco, all of those companies should benefit, Mondelez should benefit from an increase in tech and AI because it'll help them streamline their product production. But me, I dislike the cyclical nature of the consumer market and how the herd buys into that cyclical nature. Because if you think about it, oil is cyclical in nature. Higher demand in the summer and on holidays. Natural gas is cyclical. Higher production needs in the winter. Uh, Grills are cyclical. People want to use them on holidays. Cars are cyclical. More people want, you get the halfway points of the year, like where Christmas bonus, kids leaving for college, right? But housing is cyclical. So the outright consumer branding would apply to all of those things. But I think it's an umbrella that's just way too big. So if I shift it to just consumer goods, um, essentially what you could find at the grocery store, cars, grills, consumable products, then that's not a market space I like to be in because it's too erratic for me. Tech in general, everybody can profit from. Blue chips would be like solid payers, regardless of what the economy does. Bonds and proxies, we've talked about. Energy transfer, we've talked about. Oil or master limited partnership and natural gas are their own things. So it's kind of like we have these groups, but consumer is on the edge, and I really don't want to touch that. If it comes packaged inside a closed end fund, so be it. But at the same time, I'm not really targeting that. So I'm going to thin the list based on these things. Now, energy transfer will include oil and natural gas. I have not found a closed end fund that specifically or isolatedly deals with natural gas alone, or even, yes, oil, but all those companies deal with other things besides oil as well. They're known as oil companies, but they also produce a lot of other stuff. So we're going to look in energy transfer. And yeah, we can look for these things. They're going to land in some funds. But I'm going to screen it based on that six pack. But we're really going to look at just the four pack. So HFRO is real estate and it's got a crazy discount. It'll stay. Let's see, municipal bonds. We already have three, and none of them made the list based on existing discount. So would this one stay? I mean, yes, it pays a 7.7 dividend, but it's also not accounting for the tax equivalent dividend, which is generally higher. It really sits around 10%. So it could be a decent pickup. Um, it could be a decent pickup. I would leave it on the list. Calamos, I heard a great thing about it today, but let's see. NBXG is currently high. SABA, we own the sister fund with BRW. KYN stays. KYN is higher than it's been, right? They pay a monthly discount. The yield has been slowly decreasing because they haven't increased the dividend. But it's if we look at like pre-COVID, it's still a recovering dividend. So in an accelerating energy market, we would pick it up. So accelerating energy market between what it holds and energy transfer, we would buy it hoping the dividend increases. And we're just buying it before everybody else. NML is the same way. Uh, see, RFMZ, not completely tax free. Eaton Brothers, there's like a four pack of Eaton Brothers, but only two made the list. Um, I want, think of how to say this. I dislike diversification for diversification's sake. So I actually like companies that have limited investments and they do targeted investments. Like if you put $100 million into 100 companies, versus $100 million into 800 companies. It's only so much money you have. There's only so much you can buy. I don't want you to, I dislike diversification for diversification's sake. I like companies that seem to target their overall investments. And if I compare the Eaton brothers to what we already have on my end of things, it's very much like an over diversification that it's it's like 600 to 700 different funds they own, which is great because it gives you a lot of access to a lot of different funds. But it's also unlike other funds we own because those U.S. stock funds are like 100 and less, 100 companies and less. So it just doesn't hit my style. I'm not saying it's not a good company or not a good fund. It's just not me. Our LTY is expensive. It's a great idea, but it's expensive. DLY is the sister fund to DSL that we already own. Um, it could be a good addition. TEEF is TEEF is I don't want to call it a unicorn because it's not a it's a rarity in how they apply their logic. And it lands with people. Doesn't land with everybody, but it definitely lands with some. So TEEF is not oil, but everything else that they call sustainable. But it's not sustainable because it needs oil in order to be made. And it's not renewable in the sense that it regenerates because it requires oil to be made. TEEF on their company website doesn't come out and say it this way, but this is how it reads. We hate oil, but we believe in all these other products. Well, the interesting part of that is it takes oil to make all these other products. So it's just kind of interesting. And I think there is a great purpose and position for solar and um, water-based energy, not windmills, but hydroelectric. There we go. Um, I think there's a great call for that in certain situations, but I dislike their desire to make everybody do it, whether they want to or not. The other interesting part of TEEF is it's a term fund. So you're buying it on discount, and I think it liquidates in 2031. And whenever it liquidates, it'll pay you the current net asset value. So current, like you would buy it for 11.79 today, and when it sells, you would get it for whatever the current NAV is. That's interesting, but I don't know if it's interesting enough to buy what they're selling. Um, yeah, I mean, price wise, it's priced well. The other part of this is 80%, at least 80% of all solar panels made come out of China. And the US and China are still going back and forth on tariffs. So that's weighing this down as well. Um, I, I want to say I made a video at some point and said if it hit, if it dropped below 12, maybe that's a good time to buy. And yeah, on price, maybe it is a good time to buy. I just don't know if I can buy into the overall mentality they're selling. CIF is the roller coaster ride. It seems to trend with rates. So if rates drop, the price should rise. That's what happens with bonds. We bought it knowing it would be a roller coaster ride. And think of anything, yeah, we bought it knowing it would be a roller coaster ride, but it's not something I want to hinge an entire portfolio on. USA, I've talked about st stocks to bonds and foreign, but I prefer US. CLO is not my jam right now. HGOB is I won't say top heavy. HGOB is has gone up in price. Um, NPCT is another bond company that would It would give us a different angle than what we already have, but I'd have to dig into it a little bit more. River uh, seems like an overall thing, but they've got a heavy part with BlackRock, and that's not. I'm not a BlackRock guy. Hicks doesn't meet the benchmark. BlackRock is not my style. CLO, 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 CLO. And that leaves us with this. Um, but if I was going to cut it down further, I mean, because there's still a lot of option here, right? But if I'm going to cut it down further and really hammer home or stick with the recommendations I was going with, I would buy like we already own BRW, and it's the price has dipped a little bit, so it seems like a great time to pick it up for a little cheaper than it's been. I really don't want to pay $2 more, $3 more just to buy an intro stake in a fund when I could buy something I already have. Uh, TEEF, I would much rather just buy oil because oil fuels all the supposed replacements of oil. So if you nix oil, then you also have no replacements for oil. So I'd rather just buy the oil. Um, and municipal bond, it RMM would be an option on the municipal bond front. And I have to dig in and see what angle it offers us that's different than the three we already own. The three we already own. But that leaves us with this. And DLY, it does have a different portfolio than DSL, but it's also $7 more than BRW. So that trims it down to this. Let's see, bonds, US stocks, tech focused. It is a master limited partnership, but it's oil, natural gas, and energy transfer. Same thing with KYN. Municipal bond and real estate. That's honestly, that's where I would leave it. And it would come down to a couple things. One, how much we had to invest. I mean, you only have so much money. You can only buy so much of things. If we wanted a starter pack of this, so let's see, we could pick up 100 shares of everything, right? And that would put us at about 6 grand. But if you only have 5 grand, now you got to trim something off the list, or you have to cut back in shares. Like you could put 80 shares. Me, I like sets of 10. I really like sets of 50. Um, it's just easier on the math and keeping track of dividends. Um, if it came down to money and what we already own, I mean, we already own municipal bonds. RMM would have to offer us something we didn't already have. So if that was the case, like if it didn't really change things, it would be the first thing to go. Secondly, would be HFRO. HFRO, adding it would still be a great deal because it's a great discount, but it also would increase our overall cost to share, which is honestly the game you play. As the market does this, right, you're going to buy at different price points. You're going to buy some higher, you're going to buy some lower, and you're looking at the overall average of things. So even though it might be $1 or $1.20 or $1.50 more than what your current average share is, overall it might raise your overall average share price a little bit, but in the grand scheme of things, it's not that big a deal. But of where the market is right now, I would me, I would almost forego, oops, I don't want to switch those. I would almost pass on these two and focus on the above. I've been a long-standing supporter of BRW. I've said so on pretty much every video. I mean, it's a shareholder focused, active, proactive shareholder fund in the sense that they're advocating for shareholders to get better dividends and better returns. USA, it's a powerhouse blue chip, but It's tech focused on companies that aren't just outright tech. And that's where we want to be. And these two guys, we haven't bought in a while, but current discount and the more we find out about AI's needs, I mean, so if I as I use ChatGPT to help revise my book, every single time I hit enter and it runs through all these databases, it's using 10 times the amount of energy of the standard Google search. So the more you talk with AI and the more it talks back, it's using an exponentially increasing scale of energy compared to your standard internet search. You're going to have to cool a server somehow. And with the advent and the onset of both the current AI race and the Trump administration's direction towards this golden dome over the United States, golden because of the golden age and the AI race and everything else, but the golden dome, this uh, incredible defense system, right? We're going to need a ton of oil to power the technology. To every single microchip requires oil. So we're going to need a ton of oil in order to fabricate and manufacture all the technology. And we're going to need a ton of natural gas in order to cool it all. So it sounds like a great opportunity to get in on that now on the upslope. And if you look at the traditional graph, right, it's X, Y, we're like here, right? It just makes sense to buy more of it now, knowing the trajectory we're all going at. So or the trajectory we're all pointed at. So I think all six present a good option. I have not dug into RMM, but I would be interested to see what else their portfolio breaks out to. HFRO we already own. I think we own 1,000 shares, and we'll look at that. How about that? We'll look at that. This is our portfolio. It's not completely updated. I need to add USA to it, but quite honestly, I've been waiting on time to have video or waiting on. I've been working on finding time to make a video about how I update our portfolio and this dividend page and how they link together. Um, I've been waiting to do that, and I was going to use either ASG or USA to do it. I just need to honestly have the time and find the time to do it. But this is our portfolio. So if we go to HFRO, so current price and how it impacts every buy we've made at 6.7, we'll say. I mean, that would sit considerably higher than everything we've got. So let's see, how would that factor in? And I don't know if you can see the calculator on screen. So at 668 and 100 shares, that's $668. We add that to the money already invested, 63, 27, 66. So almost 7 grand. We divide it by not 1,200, we would buy another 100 pack. So that's 1,300. And it would raise it 11 cents. So I get that it's 6.8. You're looking like $1.60 difference ish, $1.40 difference. But how it breaks down in the grand scheme of things is it just raises our average share price 11 cents, which is not that big a deal. So HFRO, I was wrong. It's 1,200. HFRO would be a decent ad for us. I would like to dig in more with RMM and see how it compares to the munis we already hold. But otherwise, that's the list for the week. So let's see. So how can I say this at the end? I'll say it this way. The herd's panicking. fine, let them, right? Because when they sell in fear and they chase shiny objects. I mean, the herd is very much like the market in general. The market is it's a stumbling toddler going after the next shiny object, right? So as the herd chases the current shiny object, we're shopping in the bargain bin and we're already looking ahead to what's next. So the herd can do whatever it wants. That's fine, right? We're aware of them. We see what they're targeting. And at the same time, we're not following them. We're shopping in the bargain bin for stuff they're afraid of. And we're looking ahead to what's next before they even get there. So if you found value in the video, hit the like button, drop a comment, and let's hack the algorithm together. When you comment on videos and share them, and when you like the videos, all of that tells YouTube that it's content that somebody else should see. So if you have a channel and you're involved and commenting on other videos, it's helping your channel. And at the same time, when you comment on my videos or like videos or share my videos, it's helping my channel. So let's hack the algorithm together. And then, gosh, last week was so crazy. Last week was so crazy. And today was, and honestly, today I would have loved to have watched the entire funeral and honor ceremony for Charlie Kirk. I couldn't fit it into a day. But I'll find it on YouTube at some point this week and watch it over the week. But I will reiterate what I said last week. Our lives need clarity. And there is no better lens than the Bible. So if you have never picked up a Bible, then find one. And if you haven't opened yours in forever, then dust it off and start reading it. And if you read it frequently, then talk about it with other people. Everybody's everybody's wondering why, and everybody's looking for truth. And humanity's truth and society's truth changes. But if you want the absolute truth to everything, it's inside that Bible. And you will find God's truth, and his truth never changes. And it's honestly, it's more important than anything else we do. It if you can find how to say this, the single most greatest relationship you can have in this life will get you to the next life. And that's a relationship with Jesus Christ. And all the little stuff that we do, all the passions we have, and the pursuits we enjoy. At the end of the day, when your life is over, those things will go on. And it's when you go into the next life, the greatest decision you will face in this life is choosing Jesus or choosing anything else. As much as I love finances, as much as I love my family, as much as I love my family and finances and hacking financial freedom and helping other people, as much as I love all of those things, nothing is as important as my relationship with Jesus Christ. And in that relationship with Him, nothing else gets me to heaven besides Him. And if you think I'm crazy, fine. If you unfollow my channel, fine. If you I think I'm a wackadoo, that's fine too. But if you do, I would challenge you to pick up a Bible and do some reading and challenge your belief that I'm crazy by reading the Bible. I will say it again. Our lives need clarity and we need truth. And outside of God and His Word, the Bible, and His one and only Son, Jesus Christ, and in His moving Spirit, there is no other truth. God's truth is absolute, it doesn't change. And there is no better lens to find truth and clarity than a Bible. So you should read it. Even if you read it to prove me wrong. And don't read it to prove me wrong in the sense of I'm going to prove that guy wrong. And you can read it to try to refute what I'm telling you. Jesus loves you and He wants to know you and He wants you to know Him. He already knows you. He wants you to know Him. Read it and see if you can find God's love in every book. And read it and see if you can find Jesus in every book. And see if you can find His love for you in every book in the Bible. And I would say start in the Gospel of John, and read Acts and Romans. Go back and read Genesis, read Proverbs, which is a wealth of wisdom. A wealth of wisdom. And if you want right and wrong, read Leviticus and Deuteronomy. Deuteronomy really sets up how governments are formed and nations built. But if you want truth and you're wondering what's the big reason for all this other stuff and how do finances fit in, read the Bible. By all means, try to prove me wrong. Try to prove me wrong. That's fine. Unfriend the channel, unfriend me. Doesn't matter. I love my family. I love finances. I love my passions and what I pursue. But if there's one thing I could tell you that'll completely change your life, Jesus can change your life. So pick up a Bible and read about it. So finances wise, we've covered it. Life wise, finances wise too, we've covered it. So I wish you a great week. If you want to comment on the video, if you think I can improve the videos, if you want to tell me what you're buying and why, I'm all for it. And in fair point, if you have comments about the Bible, or you want to read specific stuff about the Bible, or you want to know what I'm reading in the Bible, then by all means comment that too. So I wish you a great week. I wish you success and growth and prosperity. And I wish that you make progress across the board. Life, finances, your spiritual life, your prayer life, wherever it is that you're working and cultivating and growing, I wish you success. And I wish you a great week. So have a great week, everybody. Bye-bye.